Hello, global trade champions. Let's grow together. I'm excited to share that I've re-recorded and uploaded the Understanding Currency Exchange Rates video, making it even more listener-friendly. You'll also find links in the description and comments where you can download the presentation featured in the video as a PDF file. I'm thrilled to have you join me as we explore the intricate world of currency exchange rates in international trade. This video is tailored to help you navigate the complexities and significance of exchange rates with confidence. Before we jump into today's content, let's set the stage. Understanding currency exchange rates is crucial for anyone involved in global business. Whether you're an importer, exporter, or investor, exchange rates shape your costs, profits, and competitive edge. In this video, we'll delve into the key factors influencing exchange rates, their direct impact on trade, real-world cases, and practical strategies to manage currency risk. By the end, you'll not only grasp how these dynamics operate, but also how to turn them into advantages for your business. Let's get started. We're going to take a look into the world of currency exchange rates. It's something that touches everyone: countries, businesses, individuals. But not many understand how it works or the powerful forces behind it. Through this video, you'll have the tools to navigate and even leverage these forces for success in international trade. To make the most of today's topic, I suggest you sit back and enjoy the video first. Once you're done, you can download the PDF materials from the Google Drive link in the description or comments for a deeper dive. If any questions come up while reviewing the material, feel free to leave a comment, and I'll be glad to assist. Currency exchange rates are the value of one currency compared to another. They determine how much of one currency you'll need to buy a certain amount of another. Exchange rates fluctuate constantly, influenced by interest rates, inflation, and a nation's economic performance. The global marketplace is always moving, always evolving, and exchange rates are the pulse of this interconnected system. Now, let's talk about what drives currency exchange rates. Economic growth, interest rates, inflation. These are the cornerstones. When a nation prospers, its currency strengthens. When inflation rises, the currency weakens. Understanding these factors is key to making smart decisions in global trade. Let's take a closer look and explore it from multiple angles. When a country experiences strong economic growth, it often leads to a rise in foreign investment. Investors seek opportunities in countries with high growth prospects, as businesses and industries in such countries are likely to generate higher returns. This increased demand for the country's assets leads to higher demand for the local currency, driving up its value. Furthermore, the following factors also determine or influence the exchange rate level. Geopolitical events such as political stability, government policies, trade agreements, and international conflicts can impact currency values by affecting investor confidence and economic outlooks. And market sentiment, like investor sentiment and speculation, can drive short-term currency movements. Perceptions of future economic conditions, interest rate changes, or political events can lead to significant shifts in exchange rates. Last but not least, a country's balance of trade, difference between exports and imports, can influence its currency. A trade surplus, more exports than imports, often strengthens a currency, while a deficit can weaken it. How exchange rates impact both sides, exports and imports, of the trade equation? A strong currency makes exports pricier but lowers import costs. A weak currency? It boosts exports but makes imports more expensive. For businesses, these movements can mean the difference between a profitable year and a challenging one. Currency fluctuations can directly affect profit margins. For exporters, a weaker home currency can increase profit margins when foreign revenue is converted back to the home currency. For importers, a stronger home currency can reduce costs and improve margins. Further, as pass-through effects, businesses may pass on the increased costs or savings due to currency fluctuations to customers. When a currency strengthens, it changes the game. Exports become expensive, less competitive in foreign markets, and that can hurt demand. But there's a silver lining. Imports become cheaper, giving consumers and businesses access to foreign goods at lower prices. On the other hand, when a currency weakens, exports take off. Suddenly, your goods are more affordable abroad. But there's a catch. Imports become more expensive. You need more of your currency to buy foreign goods, which can hurt businesses dependent on overseas suppliers. That's the dual edge of exchange rate fluctuations. It may answer the question, how exchange rates impact both sides of the trade equation. Let's look at some real-world examples. First case is the U.S.-China trade tensions in 2019 to 2023. The U.S.-China trade war caused significant fluctuations in the exchange rates of both the U.S. dollar and the Chinese yuan. As the U.S. imposed tariffs on Chinese goods, the Chinese government allowed the yuan to depreciate to mitigate the impact on exports. The weaker yuan made Chinese goods cheaper for international buyers, helping Chinese exporters maintain competitiveness despite the tariffs. However, this devaluation raised costs for Chinese companies importing raw materials and goods priced in stronger currencies like the US dollar. Next case is the British pound and Brexit in 2016 to 2023. Following the Brexit referendum in 2016, the British pound experienced sharp depreciation against major currencies like the US dollar and the euro. The uncertainty surrounding trade agreements between the UK and the European Union, EU, led to a weaker pound, which persisted over the years. This fluctuation affected various sectors, especially industries heavily dependent on imports and exports. The depreciation of the pound made British goods cheaper for buyers in the EU and other regions, temporarily boosting exports, while simultaneously increasing the cost of imported goods and materials, particularly from the EU, leading to higher input costs for UK businesses and inflationary pressures on consumer goods. Now let's look at it from the perspective of individual export and import companies. Currency exchange rates significantly influence international trade by affecting pricing, profit margins, and overall competitiveness. This page provides a comprehensive overview of the strategies businesses can employ to manage currency-related risks. You manage these risks through strategies like natural hedging, balancing revenues and costs in the same currency, or financial hedging, which gives you the power to fix exchange rates. Picture it as balancing on a tightrope, but with a safety line. Tools like multi-currency accounts and foreign currency loans are your stabilizers, keeping your trade on solid ground. Furthermore, companies can use currency swaps to exchange debt obligations in one currency for another, aligning liabilities with revenue streams and mitigating currency risk. Governments and central banks don't just sit on the sidelines. Although there are differences in degree and method from country to country, they actively influence exchange rates through monetary policy and direct intervention. Whether they're adjusting interest rates or engaging in foreign exchange operations, their actions ripple through the global markets and shaping trade flows. On the other hand, we must also consider the adverse effects of government intervention in the foreign exchange market. To influence the value of their currency, central banks often use foreign reserves to buy or sell domestic or foreign currency. Prolonged intervention, such as selling foreign reserves to appreciate the domestic currency, can deplete those reserves, leaving the central bank with fewer resources to respond to economic crises or market shocks. In extreme cases, if reserves are exhausted, this could lead to a currency crisis. In this slide, we will explore the government's key foreign exchange policies, specifically the floating exchange rate and fixed exchange rate systems. A floating exchange rate system allows the value of a currency to be determined by the foreign exchange market based on supply and demand without direct government or central bank intervention. This system's advantages include allowing the country more control over its domestic monetary policy and letting the currency adjust automatically to economic conditions. However, this can lead to high volatility, making trade and investment riskier due to unpredictable fluctuations. Examples of countries with floating exchange rates include the United States, the Eurozone, for the euro, and Japan. Next, a fixed exchange rate system, or pegged exchange rate system, is one where a country's currency value is tied or pegged to another major currency or a basket of currencies. The government or central bank sets and maintains this fixed exchange rate by intervening in the foreign exchange market, buying and selling its currency to ensure the rate remains stable. The system's advantages include exchange rate stability, which promotes international trade and investment by reducing foreign exchange risks. However, it can limit a country's monetary policy flexibility, as the country must maintain large foreign reserves to defend the peg. Examples of countries using a fixed exchange rate system include Hong Kong, which pegs its currency to the US dollar, and Denmark, which pegs its currency to the euro. And several African countries, particularly in West and Central Africa, use pegged exchange rate systems that tie their currencies to the euro. As conclude this presentation, I would like to emphasize that, in international trade, knowledge is power. By staying informed, businesses, governments, and individuals can mitigate risks and seize opportunities. Exchange rates are not just numbers. They are dynamic forces that influence success in global markets. I hope this video has helped deepen your understanding of international trade and contributes to your business success. Thank you for watching. I'm Untact Mind, bringing you valuable insights on international trade. You've been watching Trade Wins Today, your go-to channel for all things related to global business. And I look forward to sharing more valuable contents with you in the future.